Dzień dobry, witam Państwa serdecznie na 5. edycji Edward Altman Lecture Series. Tym razem jest to wydarzenie online z racji tego, że nie mamy innego wyjścia, innej możliwości. W ubiegłym roku zrezygnowaliśmy z organizacji tego wydarzenia, w tym roku podjęliśmy decyzję o organizacji wydarzenia online. Językiem wiodącym dzisiejszego spotkania online'owego jest język angielski i na ten język za momencik się już przeniosę. Zarówno wystąpienia prelegentów, jak i późniejsza sesja pytań i odpowiedzi będzie prowadzona w języku angielskim. So, welcome to the 5th edition of Edward Altman Lecture Series. This year we meet online and this is the only option that we have available. Last year we decided to cancel the event because there was no possibility to organize it in person. And also we didn't decide to organize it as an online event. On behalf of the organizers, I welcome you more warmly, and I also welcome warmly our two distinguished speakers, Professor Edward Altman from NYU Stern. We can say our American guest is the credit risk guru. And the second distinguished speaker is Dr. Mariusz Cholewa, the president of the management board of Polish Credit Information Bureau. I will say a couple of words more before the speech. Let me now briefly introduce this series of events. We started in 2015 with awarding Professor Ed Altman with our honorary doctorate. That happened in October 2015. Afterwards, together with Rector, Mr. Professor Tomasz Shapiro, a series of lectures was established. We hosted first event in April 2016 with Professor Edward Altman. Next year, we hosted Professor Anthony Saunders, also from NYU Stern, then Professor Marty Subramanian, and 2 years ago, we invited Professor Franklin Allen from Imperial College. Our today's meeting is the 5th one. I would like to thank our rectors for support in organizing these events, and also I would like to thank our Dean for supporting Edward Altman Lecture Series. Without your support, organization of these events won't be possible. So you already know a little bit of the history of the events. Our today's topic is COVID-19 crisis and the credit cycle. And the speech of Professor Edward Altman will be mostly focused on the US market with some references to other markets as well, while Dr. Cholewa will focus on Polish market. Let me now very briefly introduce Professor Ed Altman. In 1968, he published seminal work on bankruptcy prediction with the model called Z-score. This is the model worldwide known, presented in many papers and used by practitioners. Since then, Ed published more than 20 books and more than 150 academic papers. This is a large number of publications in renowned journals. He is the co-founder of Journal of Banking and Finance. Moreover, Ed Altman is not only an outstanding academic, but also an outstanding practitioner. And everyone who is involved in credit risk issues is acquainted with Z-score model and with Ed's achievement. Ed, after this brief introduction, I could only say, this time not the floor is yours, but the screen is yours.
Thank you very much. That was a wonderful introduction, and I'm so pleased to be here again, so to speak, in Warsaw, with you and with your distinguished colleagues and our wonderful guest speaker, Mariusz, with me. I look forward to his talk as well. I'm very pleased also to be invited again after the initial one in 2015, because this subject is one that is still with us today, and we've been living through this pandemic now for over 1 year. I thought it would be useful to not only talk about what happened during the pandemic, but also the outlook going forward, given that the pandemic, while it's still with us, has had a big change in terms of the vaccines and the growth rate in some economies of the world. Before we talk about the future, I think it's really important to talk about what was the situation before COVID-19, before March of 2020, because it's only very important to see what was the case before to understand what could be the case after we are done with this terrible pandemic. So the next slide, oh, by the way, could we have the slides up on the screen, Pavel? Okay, thank you very much. So the title, as you can see, is not only the COVID-19 and the credit cycle, but revisiting 2020 and the outlook. Next slide, please. So where we were before COVID-19 on the left-hand side, we were in a benign credit cycle in most of the world, certainly in the United States, and I believe also in Poland. I will go through what I mean by a benign credit cycle in more detail. But even then, I was asking the question, were we vulnerable to a downturn? And how serious would that downturn be? And I was particularly focused then on the global and the US corporate debt buildup, and whether or not a debt bubble was being formed at that time. We will see during 2020, the very first time in my long history of observing and commenting and researching about the credit cycle, that during a crisis, debt actually increases rather than decreases. We'll also refer to not only non-investment grade debt, which is an area that I've studied very carefully in the United States, the so-called junk bond market, but also the investment grade market and how that has exploded over the last 5 to 10 years. I also will introduce to you, as I did then, the concept of zombie firms. And I am going to talk about this on a global level, as well as what's happening in the United States. On the right-hand side of this table, you can also observe something about what's happened since COVID-19 began in March of 2020. Remarkably, in such a short period of time, like a few weeks only, we went from a benign credit cycle to a crisis cycle, and the recession began. While we are now experiencing fairly significant growth in the US, and the outlook is quite robust, technically we are still in a recession. Following that very rapid change in the credit cycle, we had enormous support and bailout, so to speak, from the Federal Reserve in the United States, and of course in many other central banks of the world. Congressional fiscal policy kicked in remarkably quickly with
extreme success, at least success in terms of a market rebound. But still, the real economy was in a terrible situation. I'm going to explore with you, despite this wonderful rebound in the stock market and in the bond markets, whether or not there were unintended consequences from this support. And this, by the way, continues right up until today. We'll explore something about defaults and bankruptcies in 2020 and what's happened so far in 2021. We'll even talk about forecasts among leading researchers in the area of corporate defaults and bankruptcies and recovery rates as well. We'll talk about whether we're in a benign or a stress cycle today and the forecast for 2021. Next slide, please. Let's first talk about global debt rather than just the United States. This very busy slide shows the four main categories of debt in our financial system: non-financial corporates, government debt, the financial sector, and household debt. Most central banks are very familiar with these four categories, and also many researchers in leveraged finance are following this very closely. I'm going to talk mainly about today non-financial corporate debt. And you can see on the left-hand side of this table the enormous growth, not only in amount, but as a percentage of GDP. So, for example, back in 1997, a little bit more than 20 years ago, we had $22 trillion globally of corporate debt. Today, that level is close to $1 trillion. And, $100 trillion. And 93% of corporate GDP, up from 64% a little bit more than 20 years ago. And this is only through 2019. I'm sure when we update this data through 2020 and into 21, that number will be probably close to 95% of global GDP. An enormous amount for corporate debt. In addition, government debt not only has risen from 58% of global GDP to close to 90%, but we're quite convinced that government debt will have to increase dramatically to cover the enormous deficits that governments have incurred in the support of consumers, companies, financial institutions during COVID-19. And we are facing that debate right now in the United States as President Biden has great plans not only to add to the support for companies and individuals, but also a massive infrastructure bill that is now being debated in Congress. It will all have to be financed, and primarily with debt and higher taxes. The financial sector is one of the few bright spots in the world in terms of debt increases. While it has increased, it's still around 80% of global GDP. And that's mainly due to regulation limiting the amount of debt of financial institutions. Finally, household debt. We all know that was the cause of the crisis of 2008-09. And although it's not a big factor yet in the United States in terms of worrying risk, it is a major issue in many countries of the world because we've learned, so to speak, about the potential. On the right-hand side, you can see as of 2020, global debt now is 365% of global GDP, up from 217% just a little bit more than 20 years ago, and close to $300 trillion outstanding. I was concerned about this in 2019. I'm concerned about it today. But so far, the global system has seemed to have no concern with this, as debt has increased dramatically, especially with low interest rates being the main attraction for companies, governments, etc., issuing debt. Next slide. The next slide shows the enormous growth in debt in 2020 during COVID-19. And this, I'll start out with very risky, but also very important high yield debt. This is, of course, mainly a US and Western Europe phenomena. The United States, believe it or not, in 2020 had 435 billion US dollars of new issues of high yield debt. That was more than 100 billion greater than any year before, during a pandemic, during a recession. And one can ask the question, how could that happen? And I think the answer is very clear. Government and central bank support of the financial markets gave confidence to issuers, gave confidence to investors, and with low interest rates, investors were searching for yield. Indeed, they are still searching for yield as interest rates remain incredibly low. On the right-hand side, you can see also that as of the end of April, about $200 billion of new high-yield debt has been issued. If this continues for the rest of this year at this rate, it will be about 600 billion of new issues. Ladies and gentlemen, the previous high was last year at 435, which was a record year. It just seems that leveraged finance has become so attractive. And not only that, because of it, even very risky companies, the ones that normally would have defaulted, are able to get rescue financing. And therefore, the default rate in 2021 is very, very low. And it's market conditions that are doing this, not regulators, not central banks directly. And this is in contrast with many other countries of the world, including many in Europe, where interest payments and bankruptcies have gone through a moratorium. Next slide. The only thing I want to point out in the next slide is the fact that the amount of high yield debt and investment grade debt started increasing dramatically after COVID-19 became a reality in March of 2020. And this has continued. Next slide. The next slide talks about not only directly the leverage in dollar amounts, but also leverage as a percentage of cash flows of companies, both investment grade and non-investment grade. You can see that it's really spiked high to very dangerous levels, traditionally speaking. For example, on the right-hand side, you could see leverage finance for leverage buyouts reaching a critical number of average of 6 times. In other words, for every $1 of cash flow, there are $6 of debt for the average company that has gone through a leverage transaction. Most regulators would say, as a rule of thumb, 6 times is essentially the limit. And don't forget, this is an average. 50% or so of the distribution is greater than 6. Next slide, please, shows you more about leverage finance. And this is something known as the purchase price multiple. in case you're not familiar with the purchase price multiple, it basically is the amount that companies are being sold for through leverage transactions compared to the cash flows of the company. It has reached, in the fourth quarter of 2020, approximately 12 times. In other words, for every $1 of cash flow, there's $12 of debt. Ladies and gentlemen, you can see the time series going back to 2010, even back to the late 1990s. The previous high before the current situation was around 10 multiples for LBOs in 2007. And we all know what happened in 2008, 2009 in terms of bankruptcies and defaults. 12. However, the mitigating factor is that the companies going through these leverage transactions, these LBOs, admittedly have less risk than they had back in 2007 because the amount of equity in the deals are around 30 to 40%. And so debt, while still high, is not as significant as it was back in the crisis years before. Next slide. The next slide shows the very traditional leverage measure called debt leverage ratio for leverage buyouts. That is, again, the debt to EBITDA ratio, and that is around 6, as I mentioned before. The only time it was higher was back in 2007, when it was in the United States 6.2 and in Europe 6.6. These are all statistics that show the enormous increase in debt. Next slide is perhaps one that my academic friends, and hopefully there are some academics from Poland and outside of Poland listening, may say, well, Altman, don't be too concerned with the debt buildup of companies because look how much equity has increased. And particularly they are referring to the market value of equity rather than the book value. So this chart, which I put together, shows what was the debt equity ratio of US companies since 2000. And of course, it was extremely high back in 2008, almost 70%, when equity prices fell and debt had been building up for many years before that. And then it fell dramatically. And academics and even some practitioners would say, look how low it was in 2019, near the right-hand side of this chart. And indeed, they were correct. Debt equity was relatively low if you measure equity in market value terms. But I always felt that equity prices can change very quickly. And of course, we saw that in March of 2020, when equity prices dropped by more than 30%. Indeed, at its peak of the drop on March 20th, it dropped to close to 40% drop. So I looked at 3 scenarios, given certain drops in the stock market of 20, 30, and 40%. And there you see the debt equity ratio rising again. Of course, now we know that the equity markets have indeed come back dramatically since March of 2020. The growth rate has been phenomenal. During a pandemic, during a crisis, no one that I know predicted the stock market increase the way it has. And again, the debt equity ratio is relatively low. I still think we have to be concerned with what could happen on a big downturn. But in addition, this is a great signal for what companies, in my opinion, should be doing now that their equity prices are so high. Now is the time to issue equity and cut down on that debt equity ratio when they can, because it's too late once the market turns negative in terms of growth rates. The next slide gets us now to the question of where we are in the credit cycle. I always look at 5 indicators to determine where we are in the credit cycle. Let me go through those with you, because I think they are really indicative of what we should be looking at. Not to mention, of course, there are other indicators that normally people look at that are mainly macroeconomic. And perhaps Mariusz will be talking about those indicators for Poland. One is default rates. The historic average of high-yield bond or junk bond default rates is 3.3%. As of the beginning of this month, or the end of April, the consensus average for the forecast for 2021 was around 3.5%, just about at the historic average. Recovery rates, that is the prices of debt after default, were about equal to the historic average for corporate debt of around 45%. So the first two are basically saying we are in an average credit cycle. But the next 3 indicators I look at all indicate a benign indication. Required rate of returns, or the risk premium required by investors. Believe it or not, if you look at the yield to maturity, it's only around 2.6% above the risk-free rate today, compared to the historic average of 5.6% for high-yield bonds. Way below. In other words, investors are accepting a very low risk premium, even on the most risky bonds. And this is a clear indication of a benign credit cycle. Something called a distress ratio. This was a term that I defined or called back in the year 1999 when I started studying distressed debt. And someone said, there's a lot of distressed debt out there. And I said, well, how do you know that? And they said, well, you kind of know it when you see it. I said, that's not good enough. We need a precise definition. So we decided that any bond selling at more than 10% above the risk-free rate, so today, for example, in the United States, the 10-year U.S. Treasury rate is about 1.6%. So 10% above that is 11.6%. What percentage of high-yield bonds are trading at more than 10% above? The answer today is only around 4%. Historically, it's around 10%. So again, benign. And liquidity. Ladies and gentlemen, there is so much liquidity out there. Individuals, but particularly financial institutions, not only in the US, but globally, are buying up risky debt like never before. Again, searching for yield. So there's ample supply. So my conclusion is, right now we are in definitely a benign credit cycle. And that means low default rates in the outlook. But the question is, how long will that continue? Next slide, please. This slide shows you that yield risk premium that I was talking about, or the spread. There are 2 types of yields we look at, the option adjusted and the yield to maturity. This shows that the option adjusted spread currently is around 3.2%. That's very reminiscent of what it was back in 2007 and a couple of years before that, when it was risk on. Let me conclude that the market says risk on. Don't worry about risk. I'm more interested in return. And even if that return is a lowest spread or one of the lowest I've seen, it's still sufficient to attract investors. And by the way, not only in corporate debt, but also in some types of government debt. And this is giving governments tremendous optimism to issue more debt. In other words, we are in euphoria with debt issuance. But does that mean a bubble is building? I believe there is some credibility to that conclusion. Next slide. The next slide is really important. This shows, the blue line shows non-financial corporate debt as a percentage of GDP, kind of like a debt cash flow ratio for the economy. And this is the United States. And you can see there were 3 peaks in the blue line prior to the current situation. The red dotted line shows default rates in high yield bonds. Notice that every time we had a peak, it was followed, a peak in debt, it was followed very quickly by a peak in default rates. Now, the main reasons, of course, were this was coincident with a crisis and a recession. Fast forward to the right-hand side, we see the current situation. We were already at a peak in the blue line before COVID-19, at around 47%. This skyrocketed to 57% during COVID-19 because 2 things happened. One, debt continued to increase throughout 2020, and GDP fell. And so the numerator went up, the denominator went down, and the ratio went way up. You could see a big drop down in the 4th quarter of 2020 to around 52%, which is where we are today. But 52% non-financial corporate debt as a percent of GDP is by far higher than any other peak we've seen. Now, the default rate, the red dotted line, acted the way we expected until the beginning of 2021. And now it's fallen because in 2021, the government support for companies of all sizes, support for government bonds, support for mortgage debt is so strong that the markets have said, we are not concerned. And as a result, default rates have fallen to around the last 12 months of 4%, a little above the historic average, but nothing like it could have been. So we've dodged a bullet, so to speak. And I'll come back to that issue at the end. The next slide shows, again, these default rates relative to economic recessions. The yellow bars represent recessions in the United States. Yes, ladies and gentlemen, we're very fortunate in the United States. We have many recessions. And therefore, researchers in the credit area have lots of observations about credit risk. And notice those peaks in default rates following the recessions. And of course, it went up in 2020, but not as high as some had expected. And I'll go into the forecast later on. In fact, let's talk about forecasting high yield bond default rates. Next slide. Well, the next slide shows you 3 techniques that I use to forecast default rates. Professor Małgorzata has mentioned very nicely that, in fact, I have to and want to not only talk to academics, but also practitioners. And so we need to explain very carefully how we come up with our forecasts. And I use 3 techniques. One of this is something I developed in 1989 called the mortality rate approach. And the other 2 are market phenomena, the yield spread and the stress ratio. Next slide. The next slide shows you standard actuarial formulas for calculating mortality rates for people and also for companies. The marginal mortality rate and the cumulative mortality rate. You can look at that at your leisure, but let's take a look at the results on the next slide. The next slide shows you a very important matrix. It's a lot of busy numbers, but basically, we've looked at every new issue of corporate bond since 1971 and every default that has taken place, and calculated frequency of default based on the initial rating of the corporate bond from AAA down to CCC. And those numbers now in this table form the basis of not only forecasting, bond rating equivalents and their default rates, but also forecasting default rates. We plug in new issues by rating, and out comes our forecast. The next slide shows you the same data, but dealing with recovery rates as well. And therefore, I can't see it on my slide here because it seems to be blank. But anyway, there's a similar table for loss rates, which adjusts default rates for recoveries. Next slide, please. The next slide shows regression analysis of how today's risk premium or spread can forecast tomorrow's default rate. And this regression line, as you can see, is extremely accurate, with maybe 60+% of the variation in the dependent variable explained by the independent variable. The independent variable is current yield spread from investors. The dependent variable is next year's default rate. And we can use that to forecast next year. We can do the same in the next slide please, with respect to the distress ratio. And again, extremely high accuracy in the R square of this equation. All of those three together lead me and others to forecast default rates. Let's take a look at the next slide and see what the experts are forecasting for 2021. I've listed 12 forecasters. By the way, someone once said, never forecast. But if you do, never put it in writing. But if you do it frequently. Yes, ladies and gentlemen, forecasters do it frequently, especially since COVID-19, because things are changing so fast. So this chart shows myself and 11 other forecasters, mainly the main rating agencies and many very large, sophisticated investment banks, and the consensus at the bottom. So 2020, this is actual now, not forecasted, actual 2020, a high yield bond default rate was 6.7%. That's in the lower part of the graph on the left-hand side. And for leveraged loans, which is the cousin of high yield bonds, but in the loan market, it was 5.7%. Both of them about twice the historic average. Not surprisingly, this happened during COVID-19. Incidentally, in the United States, we have not had a moratorium on bankruptcies. We have not had a moratorium on interest rates like many other countries have instituted. But we've had support for the companies, directly by the Fed and indirectly by financial markets. The right-hand side of this graph shows the forecast, both at the beginning of this year, 1/1/2021, and also just a week ago, as of the 30th of April. Look how much the forecasts have come down since the beginning of the year. It was 5.2% for 2021 at the beginning of the year, and now it's 3.5%. I've come down too, to around 3%, lower than the historic average. This is mainly because companies simply have not failed into 2021 so far. And the outlook is the drop in defaults will continue. Let me say a little bit about other countries. Many other countries, including Poland, including Italy, including Germany, including France, including the UK, have seen default rates actually drop in 2020 during the pandemic. And that's because of a moratorium for many companies to pay their interest, and also in some countries, they've essentially outlawed bankruptcies. What's going to happen when this moratorium ends and when bankruptcy will be allowed again? Well, there's no question in my mind it's going to go up, these defaults and bankruptcies. How much is also a function of whether or not investors are still willing to buy the debt of these companies, and also the growth in GDP of these countries going forward. Next slide, please. The next slide shows indeed what happened in 2020, and so far the next slide after that in 2021. Despite tremendous support from the central bank and Congress, in the United States, we had 180 companies going bankrupt with more than $100 million of debt. And we had on the right-hand side, 60 companies going bankrupt with more than $1 billion of debt. Both of those record years in terms of Chapter 11 rankings in the past. The previous highest year was 2009, and you can see how much higher the 2020 was. In other words, big companies failed in very large numbers, mainly energy companies, restaurants, retail companies, and entertainment and restaurants, as I said, and some communication companies. That's all changed in 2021. Next slide, please. In 2021, so far through the end of April, essentially 4 months of this year, 35 companies have filed for bankruptcy worth more than 100 million. If we extrapolate that for the rest of the year, we'll have 105. That is certainly relatively high to the past, but still, compared to last year, 2020, much lower. And billion-dollar bankruptcies are at 8. We forecast 224 for the full year, compared to 60 last year. There's no question in my mind that not only will large companies have less bankruptcies, but probably smaller companies too. Indeed, in 2020, small companies had very low bankruptcies. I expect them to start increasing as we get closer to the end of this year, but it won't be until 2022 or 2023 that we see bigger increases among small and medium-sized firms, which makes credit risk and analytics even more important for SMEs, small and medium-sized companies. And I am currently involved in not only research, but leading a company in the UK called Wiser Funding in this area of SME credit analytics. Next slide, please. This shows the relationship between default rates and recovery rates. Perhaps you've seen this work before. We published it in 2005, and it was based on a grant we got from ISDA, the International Swaps and Derivatives Association, in 2002. It shows a very clear negative relationship between default rates in a year and recovery rates. Recovery rates are defined as the price of bonds, just after default. And we can also use this relationship to forecast recovery rates. So, for example, in 2020, the actual default rate was about 6.7% for high yield bonds. And if you go take that line and go perpendicular up to the regression lines, you'll see that they interact somewhere between 40 and 45%, which is a little below the historic average. For 2021 now, the expected default rate is around 3%. And you can see that, therefore, we expect recovery rates to be more or less average around 45 cents on the dollar. And it is one of the ways we can forecast whether or not what the recovery rate will be and whether or not we're in a benign credit cycle or not. We are certainly not going to have what seems to have happened on the right-hand side when default rates were 10% or more and recovery rates are very low. But rest assured, if default rates will go up, recovery rates will go down. It's simply a very clear case of supply and demand for the debt securities of these companies. At least that's our opinion. Next slide, please. Let's switch now from high yield debt to investment grade debt, triple B rated bonds. Now, being in Poland, my guess is that you have very little junk bonds. And probably most, if not all of them, are fallen angels. And so triple Bs are probably the lowest rating category for new issue debt to take place. Perhaps Mariusz can comment on that in his talk coming up. But in the United States, not only did we see growth in high yield debt, but also enormous growth in triple B rated debt. Ladies and gentlemen, triple Bs now are by far the largest rating category of any rating, investment grade or not, close to $4 trillion in 2021, and around 57% of all investment grade debt, triple Bs. Tremendous growth. Big question, how much of those triple Bs will actually be downgraded in the future to non-investment grade? And what impact will that have on default rates? We've studied that. Next slide, please. Next slide just shows you the tremendous proportion of triple B rated debt, both bonds and loans, compared to the other rating categories. Next slide shows you now how we looked at the triple Bs. This is the now, I guess, fairly well-known Z-score model, something we developed back in 1968. Yes, ladies and gentlemen, before many of you were born, we developed this model. And after 50 plus years, believe it or not, it's being used by more people than ever before. And some variants on this Z double prime as well. What we did is we applied the Z-score and calculate bond rating equivalents of the Z-scores. They're given in this next slide. Next slide, please. Thank you. And you can see the last time we did it was 2018 to 2020. We look at large numbers of issues of various ratings and look at their average or median Z-scores. And you can see that Z-scores generally range from around 4 for the most creditworthy companies down to about 0. By the way, do not use 1.8 as the cutoff score for distressed companies, which is what we published many years ago. If some of you are teaching it in your classrooms, use a more updated figure like the bond rating equivalent of 0 for D-rated category. The next slide after this shows you the Z double prime model that I like to use for companies outside of the US and also non-manufacturers. And the next slide shows you the bond rating equivalent. The next slide shows you what percentage of those triple Bs back in 2019, before COVID-19, looked like they did not deserve triple B ratings. In other words, we questioned the rating agencies. And we came up with around 30+% look like less than triple B. And we expected a large number of them to be downgraded in the next downturn. Maybe not 35%, but certainly more than the 10% maximum that the rating agencies were predicting. The next slide shows a large number of companies, both in the US and in Europe, that indeed were downgraded, became fallen angels right after COVID-19, primarily in April and May of 2020. And globally, it was close to $400 billion. We expected $600 billion by the end of 2021. But we're probably going to be wrong. That close to $400 billion globally and around $270 billion US has stagnated. No longer are companies being downgraded. We think they should be, but they're not. And the reason is enormous rebound and support from the government at the corporate level, even fallen angel level. Let me skip now, in the short time remaining, to slide 34, about 3 more slides, Pavel. That's it. I want to introduce the concept of zombie firms. What is a zombie? Why is it important? How best to measure it? And let's look at it by country. First of all, definitions. Well, a general definition is a company that is being kept alive artificially by bailouts, by government support, by regulators, by market conditions, when in normal conditions, these companies would have failed, become insolvent, and probably had to liquidate. But they are being kept alive. A primary one historically has been where banks provide low-interest loans to companies simply to pay back their interest, so they wouldn't have to write them off and take a hit to their own balance sheets. The next slide shows another definition of zombies and its potential impact, this time in the United States. This shows one definition of zombies. I don't ascribe to this. I don't believe it's correct, but some practitioners are saying that, in fact, a zombie company is where they do not have enough earnings to cover their interest, but somehow survive. And this chart shows that one estimate of this is up to 20% of US companies are zombies that have coverage ratios less than 1. Next slide, please. Now, this is another way of looking at coverage ratios, one that I think is a better one, and that's using cash flow, or EBITDA, earnings before interest and taxes, depreciation, and amortization, compared to interest less than 1, and using a 3-year moving average over time. And this shows in the United States that something like as much as over 25% back in 1990s, and more recently around 22-23%, left-hand axis, shows how many companies have cash flows less than interest in the United States for the last 3 years. This is a very liberal definition. We have expanded on that liberal definition and included a second filter. We look at Z and Z double prime scores where the last 3 years, the company looks like it should go bankrupt by the bankruptcy prediction model, but it has not. And this is shown in the next slide. So, for example, in the United States, if you look at the left-hand, the red bars represent the number of listed companies that we looked at. So in the United States, that's shrinking somewhat, and it looks like something like 2,500 companies in our data set. The left-hand axis shows you the percent of companies that have both a cash flow coverage less than 1 and a z-score less than 0. And it looks like as of 2019, the last time we looked at the numbers, it was around 12, 13% of the companies. I believe that the correct number now, if we correct for certain data issues, I don't have it here, is around 8% for US companies that meet our definition of zombie. These are companies being kept alive artificially. Since we're getting short of time, I'll just go quickly through a couple of the countries and end up with Poland. Next slide, please. The next slide shows the next slide shows the US for both coverage ratios less than 1 and z-scores less than 0. And there you see that ratio being a little under 8%, left-hand slide. Sorry about that. So around 7.5%, 8% US companies we think are zombies. We're beginning to, this is very preliminary work. We're beginning to write this up with 2 colleagues of mine. We hope to have a pretty good version of our working paper probably by this summer, and hopefully it will be published in the not too distant future. Next slide, please. This shows France, coverage ratios, enormous amounts, 27% in 2019. That's the left-hand axis. Next slide, please, shows you z-scores, and then the slide after that shows both z-scores and coverage ratios for France. Our conclusion for French companies is something like 10.5%, 11% of French companies. But notice the trend in that going up dramatically from 2010. France, being a Western European country with a large safety net for companies, are now supporting companies dramatically, so that leverage ratio, that zombie ratio is going up fairly dramatically. We have, next slide, please. We have data on China. And if you go 3 more slides, the last slide, we have Poland. So this is, again, preliminary, and it's only based on listed companies in Poland. In our study, we are also going to, where possible, look at non-listed private companies, and we expect the results to be perhaps different. We're not sure if the private ones are going to be higher or lower, and we can perhaps discuss that in the Q&A. Do you think there are more zombies among publicly owned companies, listed companies, or private companies? I think there are arguments on both sides of the position. With respect to Poland, what we're finding is that the cash flow coverage ratio in Poland is, like many other countries, fairly high, less than 1, something like 20, 22%. But the number of companies whose z-scores and cash flow, the bottom 2 lines there, that are less than 0 for z-score and less than 1 for EBITDA. Oh, no, this is just EBITDA. I'm sorry. So this is EBITDA. wait a second, let me get this correct. EBITDA and Z-score, less than 0, looks like around 6% of Polish companies, slightly less than the US. I don't know if that's the right number, but it's according to some colleagues who I've talked to, it's not a big issue now in Poland, because Poland has something that is very unusual compared to many other countries. In Poland, companies cannot have negative net worth, liabilities greater than assets. If it does, it must restructure or go bankrupt and try to restructure that way. Well, many countries have a lot of companies that have negative net worth. The United States, I think if you went through it, you'd find probably 10% of all listed companies have liabilities greater than assets, but they still continue. So I would not use that as a criteria for zombies. But it does provide a kind of benchmark, if you will. Companies that have negative net worth simply go out of business in Poland. And therefore, the number of zombies will be less. Whereas in countries that are more liberal about companies existing with negative net worth, zombies have a chance to be higher. Let me now conclude. Last column, let's go to the last slide, Pavel. Thank you. Some recent observations. High yield bond and investment grade, new issuance going through the roof, so to speak. Corporate bond market prices have rebounded to normal and above normal levels, even in a recession. Quite remarkable. Default rates were trending up in 2020, but really are dropping in 2021. And while the expected by the forecasters is around 3.5% for 2021, I think it's going to be quite a bit lower and certainly below the historic average once again. So we are in a benign credit cycle. Unprecedented early support for the U.S. from the U.S. Central Bank. Successful? Absolutely. Unintended consequences? Absolutely, in my opinion. They did not expect such an increase in debt or equity. Finally, my recommendation to companies that have experienced high amounts of debt issuance, low interest rates, take advantage of it. Okay. But sooner or later, and hopefully sooner rather than later, it's time to start issuing equity. And I'm not talking only about the SPACs, S-P-A-C-S. That's a subject for another seminar, which are issuing equity in tremendous numbers. But these are technology companies. These are IPOs of smaller companies. These are not the established companies in the market. And finally, global zombie firms increasing in many countries. Yes, a potential worrisome trend. With that, I will conclude. Thank you for your patience, and we'll be around for questions at the end. I turn it back to our distinguished colleague, Małgorzata. Thank you very much.
Thank you very much, Ed, for your great presentation. Now that's time for the second speaker, Dr. Mariusz Cholewa, who is the president of the management board of Polish Credit Information Bureau. This is, we can say, his main job. However, last year in May, Mr. Cholewa was elected the president of the Association of Consumer Credit Information Suppliers, and this association is the largest group of credit registers in the world. So, again, the screen is yours.
Hello, good afternoon. About in US, let me say a few words about my presentation and my company. Let's start with the BIK Group and at the glance. We are the only credit bureau in Poland, set up in 1997. We are owned by banks and the Banking Association, and we cover two legal entities. One is the BIK itself, and the second is the Economic Data Bureau, Biuro Informacji Gospodarczej Infomonitor, and we are, as a BIK, connected with every bank here in Poland. It will be on the next slides, but the Economic Data Bureau is related to the real economy. So we cover the information about almost all adult citizens in Poland and close to 3 million enterprises. And in terms of the companies and data sources, and we as BIK, we cooperate with all banks in Poland, credit unions, loan companies, payday loans, leasing companies. We cover the all financial sector, and we have our database is updated twice a week, so we have really fresh data when we know what's going on the market. And thanks to our data, we also support the Financial Supervision Commission, Central Bank, and another government bodies with some statistics. And I will share some of the recent statistics about the credit cycle in Poland with you. And through our daughter company, BIG, we cooperate with real economy, so with telcos, media suppliers, and some debt collection companies as well. And we have, in that area, we have mostly the negative data. But in BIK, we have the all credit history of all Polish creditors and enterprises as well. Okay, starting with the big picture. So on the balance sheet, the banks have more than 700 billion of Polish zlotys is the outstandings, and 70% it's the mortgage loans and 23% is the cash loans. But on the right-hand part of the slides, you see the dynamics. What was happening in the last year in the sales of those products. So we see in all credit categories the negative trends. So it shows that banks and the credit institutions granted less loans than the year before, except installment loans. It was the only product with the positive new booking in 2020. And the lowest decrease was in the mortgage loans, and I will say more details about that in the second. Taking into account the average share of borrowers in the banking sector is around 47%. But taking into account the map of Poland, we see on the north and west side is the more individuals there are creditors. So in many voivodeships there are above 50%, and it is the northwest. But when we see the quality, and the quality is also related to the northwest, usually that part of Poland is the mostly exports to credit, and the more risky. And the less risky clients on the Poland are southeast part of our country. In terms of the production of new loans, this is the statistics on the monthly basis, and you see the huge drop in the hard lockdown, which was from the mid-March to the whole April and to mid-May last year. And as you see, the unsecured loan, which are the cash loans or non-banking financial providers loans, that like paydowns loans companies, and we see the decrease in the April 66% in those two categories. In terms of the mortgage loans, we have more benign trend. And we saw some decrease, and last month we see the recoveries. And the hero of last year was the installment loans. We have the declines in April, but then we have several months of positive new booking of installment loans. When you see the last results of March, and in every category you have the double-digit growth, but you have to take it into account. The base of March 2020 was quite low, so this is some result of the base. However, we see there's quite growing the demand of the loans. In terms of the quality, we do not see the huge deterioration, as Ed mentioned. So far, it's so good, especially in the mortgage loans or installment. We even see some improvement of the credit quality. We saw the cash loans small deterioration, 0.4%. The higher deterioration we saw on the non-banking financial loans, like the payday loans companies, and in that categories usually focus on the more risky clients, and the default rates in that group of institutions is above 40%, so it's quite high. And then let me say a few words by product. And so let's start from the installment loans. Before the lockdown, before the crisis, the average monthly production was at the level of 1.2 billion. And after the lockdown, when we saw the negative trend of the new booking, we saw the recovery. And since then, the average production of new loans is 1.4 billion Polish zloty, which is above the long-term trend before the lockdown. And last month, 1.7, it was the record production of the new loans. So we see the recovery in that product. We produce as a BIK the quality indexes for products and segments as well. We see the blue lines show the defaults, which the loans which went to the default, and the amount of that, and then but the percentage shows the some kind of the cost of risk for the products. And we see the positive trend. So this is the good product. This is why the banks they're focusing on that product as well, which is the growing. We see the demand, and the quality is really good. And the cash loans. After the lockdown in March and April last year, we see recovery, but we haven't reached the level before the lockdown. So during the rest of the 2020, we see the monthly production at the level of 4.3 billion zlotys. March was the record for the last 1.5 years, 5.8 billion zloty of the new production of cash loans, and we see the demand, so the growth will be there. What worries me, the extension of the contractual loan tenor. During the crisis, usually the banks, they are trying to extend the tenor and just to be able to give them more credit to individuals. But usually the longer tenor, they are connected with the higher risk. I will say about that a few words. And you see that new production of the 2021, the average tenor for the new cash loans unsecured above 50 months, so it's really high. And when you see the breakdown of cash loans disbursement before the lockdown, during the lockdown, and after the lockdown, you see this focus on the big tickets above 50Ks. So 44% of the new production in Q1 2021 of cash loans were in the area of large tickets of cash loans. And then you see the breakdown by the tenor, and you see then the between 7 and 10 years of the tenor, 34% of the new production in Q1 2021, and 5% is even above 10 years. So unsecured loans, 10 years. So it's really high risk. So this is the area which worries me. Another observation is that usually when individuals, they are taking the cash loans, the 85% or 84% of them, they are taking the cash loan in one institution. Then the rest is taken in 2 or more banks, and it is highly correlated with the credit risk. So if you have the one you have the credit with the cash loan in one bank, the average ratio of arrears over 90 days is around 10%. But if you have 2, 3 or more banks, the risk is growing 2 or even 3 times than the base. And then you see the cost of risk and the quality of the portfolio depending on the tickets. And you can see then when the individual has outstanding above 250K, then the risk is the default rates are the level of 36% is even high. So when you see the lower tickets, then the risk is the safe level. But when going to the higher outstanding, the risk is growing rapidly. And usually because we see all credit histories, usually very good indicator for the measuring the credit risk is the vintage analysis. So we analyze the credit after 1, 3, and even 37 after the disbursement of the loan, and we see how big is the percentage of the loans going into default. Default means the arrears over 90 days. And we see the production of 2018, 2019, and 2020 is on the same level. So we do not see the growing risk of the new production. However, on the right-hand chapter, you can see the quality depending of the ticket size. And you see then the ticket size above 50K, the risk is the last 3 years, the production is above 9%, but the low tickets below 4,000 Polish zlotys, it's lower than the 5%. So the bigger tickets, the bigger risk, but the new production is concentrating on the big tickets and the higher tenors in the cash loan. So this is worrying me. However, what we check whether after the lockdown, banks, they are trying to push the sales and they are concentrated on the high risk clients, or maybe they did the opposite and they concentrated on the better clients. So the answer is that the banks were concentrated on the better clients. It shows on those two slides. On the left hand slides, the vintage analysis shows the share of loans in arrears over 90 days by due, and we see the production after the lockdown is better than before, so it's good. And then on the right hand slides you see the structure of the BIK score disbursement. So you see that the better score, the better, the lower probability of default is there, and it shows that the banks were concentrated on the better clients, showing by the BIK scores. It's the dark blue line on the most on the right. Okay, and then we also checked what would be the risk, especially in the area of cash loans, and into 2020, where there is the highest risk with younger people, and it showed that there is. So the citizens, the creditors, the age before 20, they are several times riskier than the other, and the age 21, 24 is also and the higher risk. It's normal. Usually, younger people, they are more risky, but especially in the pandemic situation, they are more affected by the pandemic situation and the institution, the places where they're working for. And then our quality index. So what we saw after the lockdown, our quality index were deteriorated. It was in May and June last year. Then we saw the huge support from the public, and it was called PFR shields. But also the banks introduced credit moratorias, and I will show some statistics about that also. But this support actually frozen and even improved the indexes of risk. As Ed mentioned, it also could produce some zombie companies. The companies which survive only through the support of the public support, on the banking support, and the credit moratorias were for the 6 or 9 months, and the customers could just stop paying interest or even the whole installment. But when the credit moratorias ends, we see the growth on the BIK quality index, and the last results on the March 2021 was at the level of 4.8%, and it's still growing. Mortgage loans. Mortgage loans, it is another hero, especially on the last few months. We see the huge demand. Yesterday, even we produced the demand index for mortgage loans, and it was at the level of 90%. So 90%, the new inquiries was actually produced and reported in BIK. So we see the huge demand of the new loans. And then we see the production, the average after the lockdown was at the level of 5.5, but even the March result was the record ever results since 2008. So we are discussing about whether do we have the mortgage balloon or maybe not yet. But the quality is so far so good. The growth of the mortgage loans last year was driven by the big tickets again, like it was in the cash loans. So the individuals moved to the big cities and to the bigger tickets. And there is the long trend of the amount of requested and the granted mortgage loans last 2 years. So you can see that during the lockdown it was the decrease, and then we see the constant growth, and the average amount of granted mortgage was higher than 300,000 zlotys at the average. And then we see the quality, and again with higher tickets we see the higher risk. And the vintage analysis shows that the new production doesn't generate us the higher risk. However, again, the higher tickets, they are generating higher risk based on the vintage analysis, and it is 2 or 3 times higher. And our quality index of mortgage loans, it also shows the deterioration after the lockdown in June 2020. Then the credit moratorias and public support helped individuals, and then we saw the improvement. And last couple of months we see also deterioration, but we haven't reached the level which was before the lockdown. Non-banking loans. This is the payday loans companies, short tenor and high interests. So this part of the business were mostly affected by the pandemic, and the new production after the lockdown was at the level 389 million of Polish zlotys. Now we have the growing rates, but we haven't reached the rate of the new production which was reported in 2019. And another area which worries me, which is related to over-indebtedness. We are measuring also the number of people who has the more than 10 loans per customer. And we see that if the customer has more loans, usually more often uses the payday loans, and then the quality of the portfolio is worsening. So depending on the number of loans you have. Interesting observation that usually the more than 70% of the non-banking financial clients, they are at the same time banking clients. And what worries me, that 47% of those clients, they have at least one credit product which is delinquent above 90 days. So this there is a high risk of impacted one area to the another area, and that group of customers, they have the 5 billion of Polish zlotys of outstanding, but in the same time they have that group of clients, they have 26 billion of Polish zloty of outstanding. So this is the high risk that the non-banking financial providers may impact the banks in terms of the quality. So The vintage analysis, it shows that the stable new production of the non-banking loans, and the same, the higher tickets, the higher risk on the right-hand slides, but the level of the risk is much higher than the cash loans. And the two slides about the credit moratorias. So if you remember that the outstanding of the credit portfolio is at the level of 700 billion zlotys, but 82 billions were covered by the credit moratorias, and we have the two credit moratorias. One is the private. It was introduced by banks, and the public, it was introduced by the government. And there were some specific rules to be able to get the public moratorias. And the public moratorias were not so popular, and it covered the 2.5 billion zlotys, while the private moratorias 82 billion zlotys, and covers almost 1 million of loans, and it's almost ended, the private moratorias. When we saw the 95% of the individuals use the credit moratorias, they came back to the regular payments. However, when we compare the clients with the credit moratorias and without the credit moratorias, so the clients with the credit moratorias, they are more risky than the clients without the credit moratorias, and it's visible in the two slides, which shows share of loans in areas over 30 days on the left slides and over 90 days, and it's growing after ending the credit moratorias. Okay, and a few words about the micro entrepreneurs and the farmers, and the outstanding. Actually, the first time is in the history is lower than the year before, and it's 102 billion of Polish zlotys in every kind of the product. We saw the double-digit negative trends in the sales, and the micro entrepreneurs, the average monthly level is around 1.99 billion Polish zloty monthly production, and March was pretty good with 2.6 billion of the production, which reached the level from the 2019. In terms of the quality, we see some deterioration, but not much. 1.5% in the micro entrepreneurs and 0.5% of the share of loans delinquent. It's not the big growth. However, depending of the sector and industries, we see the construction, which wasn't affected by the pandemic, but and we see the improvement in that sector, and the biggest growth of the delinquency we saw in the services and then in the production. So this is the observation. In terms of the products, we saw deterioration in unsecured loans. Secured loans, they are stable. In terms of the vintage analysis, so it shows the new production is even better than year or 2 years ago. So it seems that no risk. In terms of the BIK score distribution, we do the score for SMEs as well. So it's stable. We do not see any changes during the lockdown, during the pandemic, before the lockdown. So it's quite stable. However, the BIK quality indexes for micro entrepreneurs, they're going north, and then default rates are growing. It was the support from the government and the credit moratorias, but this is why we saw the improvement, and now the default rates they are growing. So it is especially visible in the service sector, which is on the right hand slide. And then the private moratorium for entrepreneurs, it covers the almost 30 billion of Polish zlotys. 6 billion is the current outstanding. So this is the 30% of the outstanding of the portfolio were affected or impacted by the loan moratoria. So it helped SMEs to be safe, and probably some of that clients will become a zombie, as Ed mentioned. And we also saw that most of the companies come back to the regular payments after the moratorias, but the risk is there. So we see especially in the non-secured loans. And finalizing, we see that still the stable loan portfolio quality, mostly due to the loan moratorias and the public support. However, we see several risk factors like the young generation, the clients after moratoria, which should be under monitoring. We see the joint clients more risky of the banking and the payday loan sector. We see still the high group of over debt clients, and the risk is with the high tickets and long-term loans. And in terms of the micro entrepreneurs, we see the risk, especially in the industries mostly affected by the pandemic, like services, for example. So this is all for my side. So thank you very much. And the screen is your, Professor.
Okay, thank you very much for your interesting presentation and for giving me the screen back. So we managed to listen to two interesting presentations. The first one, delivered by Ed Altman, was focused mostly on corporate credit market, and the second one, delivered by Mariusz Cholewa, mostly on the household markets, especially on cash loans, which are very important part of bank's portfolio. Before I pick up potentially some questions from the audience, I have one question to Ed and one question to both speakers. And I start with the question to Ed. We discussed a lot about support and about corporate credit market. In Poland, corporate credit market, especially debt market, debt securities, is not well developed. Our corporations do not issue debt securities, or if they do, there are rather small amounts in comparison to other market segments. What is, in your opinion, the impact of US government support for credit market of households? Because as far as we know, here in Poland, Americans also decided to provide some support to households, to individuals. And the interesting thing is, what's the impact of this support on credit worthiness of these households or the availability of credit?
Well, with respect to the consumer credit market in the United States, the situation was quite different than the corporate credit. Indeed, there was a moratorium for many consumers, especially on their mortgages, to pay their interest during this period. This was a federally mandated moratorium. It is possible that certain states did not honor this, but for the most part, homeowners were not required to pay their interest. And that will continue through the summer, I believe, of this year. That was something that was extended under the Biden administration. But soon it will end. Now, when it ends, this moratorium, there's no doubt in my mind there will be a big increase in defaults and foreclosures on properties. Because some individuals, even with the unemployment insurance that was increased, which is also likely to end, certainly by the fall, and this moratorium on interest payments will have problems to repay. So, up to now, the number of foreclosures and defaults of consumers was very low. Similar to small and medium-sized firms who got support directly through what's called payroll protection plans, and who utilize that money to pay their employees. Once that subsidy ends, there will be an increase, in my opinion, of the defaults and bankruptcies of both small and medium-sized and consumers who have mortgage payments. The government's position on this is that with the economy increasing and with unemployment, while it's still a little over 6% and quite high historically, it's quite a bit lower than it was earlier in the pandemic. And now we have this strange situation, by the way, where many companies need workers, but they can't find them because the skills that are necessary are not available, or a lot of people up to now have decided not to look for jobs because they're getting so many subsidies from the government through unemployment insurance, and they're making more money by not working. This, of course, will end soon, and we'll find the normal market dynamics of supply and demand for labor kicking in. Then, of course, it's a question of, will these people who lost their jobs, have not paid their interest on their loans, mortgage loans particularly, will they find jobs to continue, or have they dug themselves such a big hole that they will default? I'm thinking it'll be some of each of that, but the default rate clearly will increase for both small and medium-sized firms and for individuals. And the number of personal bankruptcies, believe it or not, was down over 20% in 2020. Less personal bankruptcies, which surprised so many people until they looked at the supports that they were being given. So I think we have a cycle which is strange compared to the historic cycle when it came to crises and recessions. That's my answer.
Okay, thank you, Ed. I would like to encourage our audience to post some questions, but in the meantime, I have the following problem to solve. Lenders operate in an environment of ultra-low interest rates. Of course, for the time being, they can feel comfortable because interest rates are low and stable, but I would be happy to get, let's say, three pieces of advice from each of you, what are the most important risks because of operating in the environment of ultra-low interest rates? Who first?
I'll let Mariusz go first, but I'll be happy to try to answer that.
Mr. Cholewa.
Okay, I was mute, sorry. Sorry. When I see that usually during the current environment, the individuals and even SMEs, they're taking loans with the long tenors, and their capacity is also measured by the current interest rates. But when the interest rates will go up, some of them would be in trouble, and it would be mostly affected with the long-term loans, and especially with individuals who are taking the highest possible loan which might be possible. So it is related to the high tickets, long tenors, and this is to the all areas of individuals and SMEs as well.
In terms of the interest rates rising or not, you have these two very important forces in the market, which are neutralizing each other at the present time. On the one hand, you have the clear prospects of inflation increasing fairly significantly in the short term, at least. I think the next statistics coming out, I'm talking about within a few weeks for the month of May, will show a big spike in prices, consumer prices in particular. Everything is going up. Energy costs, food costs, commodity prices, companies having trouble with supply chain purchases, and therefore the cost of transportation, et cetera, going way up. There's no question in my mind there's going to be an increase in inflation, perhaps in the United States to above 3% this year. The big question is, will it continue or even rise beyond that? The government and the central bank are saying we will do whatever is necessary to keep interest rates from rising, certainly by making credit quite cheap, available to banks to lend out to companies, and therefore the risk of interest rates rising is not material. On the other hand, you have the pressure from higher inflation kicking in, especially if it lasts beyond, say, 2 quarters. And the experts are, I'd say the majority are saying that it's a temporary increase in inflation, but an increasing minority are saying, no, it's going to be more than temporary. The stimuli from the governments, and of course that's a big question mark, how much the new infrastructure and personal supports will be passed by the Congress. There's a tremendous pushback now from the Republicans against the Biden administration on both the infrastructure, significant amounts, and support for child care, for example, education, retraining, and the like. It's going to be a real battle in Congress over the next couple of weeks. Bottom line, the prospect of higher interest rates in the short run are probably not great. I don't think the interest rates are going to rise that much. I'd say for 10-year or longer term, there's a decent chance it will rise to around 2%, 10-year treasuries, but not much higher than that in the short run. Long term, a lot has to do with the inflation rate. And that, of course, is not only a factor for interest rates, but a big factor for the growth rate in the economy and support of stock prices and bond prices. The biggest fear that we had when the stock market dropped recently was signs of inflation. And now it seems to be modified or mitigated to a great extent. I have a different concern, Małgorzata. My concern is the level of debt. And that level of debt needs to be supported in the future. And if we do have higher interest rates, there's going to be a big problem for companies and for governments. And credit ratings of even the strongest investment grade countries will suffer. And we might see a big round of downgrades in sovereign ratings as a result. I think it's inevitable in emerging markets for that to happen. So it's a big question mark about the length of the inflation and therefore the impact on interest rates.
Thank you, Ed. So I think that we reached the end of today's event. Thank you for sharing your opinions and views. I would like to thank our speakers for the great presentations and the audience for joining us. See you someday, probably not online, but let's say in the real world. Thank you. Bye-bye.
Thank you.
Dziękuję bardzo.